All right, the final video for chapter 3, gains and losses. So this is just an overview of gains and losses, and yet we're going to be on this video for a while. So gross income includes gains, and it often, but not always, includes losses from property. So let's talk about realization versus recognition. So a realization event is a significant change in ownership rights. And when we realize a gain, we calculate it by saying what is the amount realized less the adjusted basis. That equals our realized gain. To the extent any of it is deferred or exempt, we back that out and get to the recognized gain. So in most instances, the realized gain is recognized. So let me give you a quick example of realization and recognition. So you buy stock in, let's say, the Cheesecake Factory during the year at $20, and at year end, it's worth $30. So you have a $10 per share gain. That is an unrealized gain. If you sold that stock on the last day of the year for $30, then you have a realized gain because now you've got a significant change in ownership rights. And since none of that gain is likely to be deferred or exempt, you're going to recognize all of it as well. So let's break down this calculation of realized gain or loss. Amount realized is what did you get? So that's the cash plus the fair market value of any property you receive, plus the assumption of any liabilities away from you as the seller, less any selling expenses. So just to be clear, when we think about fair market value, that's the price at which property would change hands between a willing buyer and seller when neither are any compulsion to buy or sell. In an exchange, there's a general presumption that the fair market value of the two or more items exchanged is equal. So Bill trades land to Susie for stock worth $30,000. Since the stock has a readily determined value, the land can generally be assumed to have an equal fair market value. Adjusted basis is generally the cost of that item less any cost recovery, which is often from depreciation, amortization, or depletion. But we'll talk more about basis eventually. So again, most gains that are realized are also recognized. Some losses that are realized are also recognized. Some of the exceptions. For example, if you sell personal use property, so if you sell your home, for example, that you live in, or the car that you drive every day, and this is not your business car, this is your car that you use for commuting and going on vacation or whatever it might be, any gains would generally be recognized. However, the losses from the sale of personal use property are not recognized. Like-kind exchanges, which we will get to eventually, the gains and losses are not recognized. And wash sales, another transaction we'll get to, the losses are not generally recognized. So we talk about the character. We've already talked about character of income. This is not new. We spoke about it on the first day. Ordinary is a version of character. So is capital. So is tax exempt. It's really long-term capital gains that enjoy preferential treatment. Capital gains are also subject to some netting rules. We'll get to those eventually. But truly understanding what is a capital gain or loss is important for these two reasons. First off, they enjoy preferential treatment. Secondly, they're subject to special netting rules. So we really need to know how to identify what is a capital gain or loss versus an ordinary gain or loss. Well, the default general rule is that gains and losses are ordinary. However, if they are from the sale of capital assets, then they generate capital gains and losses. Now, there are a number of exceptions that we will get to eventually, like Section 1231, 1245, 1250, unrecaptured 1250, collectibles in Section 291, all of which can change the treatment, perhaps, of the character of a gain or a loss, mostly gain. So if generally these come from the sale of capital assets, what is a capital asset? Well, it's anything that is not a capital asset. Yes, sadly, the tax law defines a capital asset in the negative. And so basically it says, hey, everything that we tell you is not a capital asset is a capital asset. So it depends in part on the purpose for which the taxpayer will use that property. And both individual and corporate taxpayers generally prefer capital gains to ordinary income. That's generally, it's not always. Even though corporate taxpayers will find eventually they do not get preferential rate treatment. So what is not a capital asset? Well, Section 1221 defines that. Inventory, a big one. Number 2, trade or business property. That is a huge category of property that is not a capital asset. Patent invention, model or design, accounts or notes receivable acquired in the ordinary course of a trade or business, publications of the U.S. government, and then a handful of other things, including supplies down there at the bottom. Not a capital asset. So different treatment in the hands of different taxpayers, as I mentioned before. Let's say Jimmy owns a car for personal use. Well, that's not on the not list, right? Just to be clear, it's trade or business property. But a car that he just owns for his personal use, that is in fact a capital asset. If Jimmy owns a car dealership that owns a car, well, since the car dealership buys and sells cars, that's inventory for them and not a capital asset. And lastly, if Jimmy operates a business in which he uses a delivery car, we will later find that that is property used in a trade or business and is not a capital asset, although it might get capital treatment. We'll see eventually. So this idea of long-term raises the importance of the holding period. And again, we discussed that, I believe, as well. But if we didn't, ordinary rates as high as 37%. Long-term capital gain rates can be 0, 15, or 20. Short-term capital gain rates are the same as ordinary rates. And this is rules for individuals. Corporate taxpayers actually only have a single rate that applies to ordinary and capital gains. So the holding period is important because it shifts something from short-term, taxed at ordinary, to long-term, taxed at preferential rates. Long-term means held for more than 1 year. That excludes the date of acquisition, but it does include the date of sale. It's based on calendar months, not the number of days. And it's based on the trade date for stocks and securities, not the settlement date. Okay, let's go over some basic netting. Remember I said that capital gains are netted, and we're just going to cover some basic netting. Eventually we'll get to far more complicated netting, but not now. Capital gains and losses must be netted against each other when the signs are opposite. That's what it means to net. If the signs are the same, then you're adding, not netting. So first you net all short-term with short-term and all long-term with long-term. So you take all your short-term gains and losses, stack them all up in a bucket. Take all your long-term gains and losses, stack them up in a bucket, add them together. Figure out what you get. You can get a net result where both are gains, short-term and long-term. You could get a result when both are losses, short-term and long-term. You could get a net gain in either short-term or long-term, and you could get a net loss in either short-term or long-term. And it's those last two that require this netting process. If both are gains, then the short term is taxed as ordinary, the long term is taxed at preferential rates. If both are losses, the short term is used as a $3,000 up to, it should really see up to $3,000 offset to ordinary income, and then any long term losses if there are any. And then if there's any that you can't, any above that $3,000 mark, you carry those over, you carry those forward, and it keeps the character of what it was for individuals. And we'll do an in-class exercise to show how that works. If it's a net short-term gain, then you treat it as ordinary. If it's a net long-term gain, you enjoy those preferential rates. If it's a net short-term or long-term loss, then you just use the $3,000 to offset against ordinary income and carry forward the rest. For corporate taxpayers, you also net all your short terms together, net all your long terms together. Since net gains are not taxed at preferential rates, the net losses, net gains are not taxed at preferential rates. Net losses are not deductible. They can be carried back 3 years and then forward 5. And then a quick blurb about virtual currency, just because it deserves a little attention. This is the Bitcoin, etc. Currently, virtual currency is treated as property. Therefore, it has basis and amount realized. Let me give you an example. Mike sells some illegal property and is paid 0.005 units of Bitcoin worth $100 on the date of the sale. In 8 months, Mike buys some stuff for 0.005 units of Bitcoin that's worth 103 on the date of purchase. That means Mike has a short-term gain, right? So first he acquired Bitcoin for 100, then he sold it for 103. He has a $3, in this case, short-term, because it was only 8 months, capital gain. All right, that's our overview of capital gains in the end of chapter 3. I'll see you in class on Wednesday.